Hello, everyone, and thank you so much for tuning in on this installment of the Vuyo Show, your source on all things global business. I am your host, Vuyo, and today we have got some really exciting and epic stories to share with you. Paramount potential bid for Warner Bros. Has gotten into the conversation. Recently, I shared a story with you guys about Netflix doing an acquisition of Warner Bros. Discovery. We did a deep dive into that particular conversation on our Monday, a Tuesday episode. But today we are doing a deep dive into Paramount's decision to come into the bid. Now, the first story is one that could really also define Hollywood, which is what we disclaimed on our previous episode, that a deal of this magnitude could really shape and change the way that the industry moves. Now, Paramount Global is exploring a potential bid as well for Warner Bros. Discovery, which is a move that, if successful, would create one of the largest entertainment powerhouses in modern history. Now, Paramount Skydance has launched a hostile takeover bid, and I use the word hostile quite specifically because that's exactly what it is, directly appealing to stakeholders after the Warner Bros. Discovery board accepted a rival offer from Netflix. Now, the bid details are as follows. The acquisition value for this particular bid, Paramount's willing to do an all-cash offer, which values the entire Warner Bros. Discovery company at $108.4 billion US dollars, including its debt. And for the per share price point, the offer is at a $30 per share in cash, which is a 139% premium over the Warner Bros. Discovery undisputed stock price as of September 10th of 2025. Now, the scope of this particular bid looks like Paramount is bidding for the entirety of the Warner Bros. Discovery ecosystem, including its TV and film studios, its streaming services, and the global network segment, which includes the cable channels like CNN, Cartoon Network, etc. Now, the financing of this deal is an all-cash offer, which is backstopped by equity financing from the Ellison family, including the Oracle co-founder Larry Ellison, and the private equity firm Red Bird Capital, along with over $54 billion in debt commitments from major banks like Bank of America, Citibank, and Apollo. Further funding sources reportedly include the Middle Eastern sovereign wealth funds, which we briefly discussed in yesterday's episode, which includes Saudi Arabia, Abu Dhabi, Qatar, and the Jared Kushner's affinity partners. Now, recently, there was a social media frenzy about how Paramount had recently had a significant amount of job cuts, stating lack of financing and funding as a reason for declining sales and declining numbers being reason for the job cuts happening. But, which had put a lot of it in scrutiny for the past couple of days, where people are asking the question, if there were all these job cuts, where did this money, over $100 billion, come from to be able to compete in this bid? Now, it underwent significant job cuts, announcing as of October 2025 that approximately 1,000 jobs, which is almost 5% of its workforce, would be eliminated following its separate $8.4 billion merger with Skydance Media. Now, aggressiveness and comparison to the Netflix bid is that it is highly aggressive, this deal, compared to what Netflix had originally put on the table, specifically designed as what we called earlier a hostile move to disrupt the friendly, more lenient deal that Netflix already has in place between itself and Warner Bros. Discovery. If you're looking at the comparison between the two bids, the hostility of the Paramount bid is that it's very hostile. It's a tender offer. It's made directly to the shareholders after being rejected by the Warner Bros. Discovery board. However, the Netflix offer, on the other hand, is a very friendly agreement with the Warner Bros. Discovery board, but now has obviously been contested because the offer has come directly to the shareholders within the other bid by Paramount. The value of the two deals is what has really caused, so much discussion and conversation, because the Paramount deal is valued at $108.4 billion enterprise value for the entirety of the company, whereas in comparison to the Netflix deal, which is only 82.7 billion US dollars, and the enterprise value for only the studio and the streaming assets of Warner Bros. Discovery. So looking at, the different price points and considering the fact that, it is definitely a higher bid, and it is a very much competitive bid to what Netflix had already, offered on the table. The price per share, as mentioned earlier, is $30 for all cash per share in the Paramount Plus deal. However, on the Netflix end, it is the $27.75 per share, with a mix of $23.25 cash and a $4.50 stock, which is in the comparison between the two. However, the scope of them is that, as I said earlier on, Paramount requires the entire company, the entire ecosystem of Warner Bros. Discovery, including the potentially declining but cash generating linear, cable networks. However, Netflix, on the other hand, wants to only, acquire the TV and the film studios and the streaming, which includes HBO, HBO Max, leaving a Warner Bros. Discovery shareholders with the highly leveraged standalone global networks as a separate entity, which is what makes this competitive deal quite interesting to speculate, because it's you looking at two different types of structures for both the deals, and both of them would be something that would take to great regards what is happening within the industry. Now, regulatory risks for the two different deals is that Paramount argues that its full vertical integration, which includes content production and distribution, will face less antitrust scrutiny because it enhances competition with dominant players like Disney and Netflix, when on the other hand, the Netflix deal is expected to face significant antitrust scrutiny due to the consolidation of major streaming assets, which critics fear could lead to higher consumer price and further increased job cuts. Now, we've also heard the White House make comments about the idea of the Warner Bros. X Netflix deal could have potential risks for antitrust. However, Paramount Plus is presenting itself as a less riskier approach in that regard because of the fact that it has a full vertical integration. So again, it's quite interesting to see how the regulatory risk of both these deals and what it potentially could do to the entirety of the industry. If Warner Bros. Accepts the Paramount's bid, it needs to pay Netflix 2.8 billion US dollars, which is what is considered as a breakup fee. However, if Netflix fails, or rather if the deal falls through, if the Netflix deal falls through, Netflix is on the hook for $5.8 billion fee. Now, we don't know what is going to be the outcome of this conversation. We will be looking quite closely at it. However, I do think it's quite a masterclass. It feels like an episode in Succession, to be honest, because there's so much deal making happening. I can only imagine in the boardroom, it's like we're trying to figure this thing out, and this person wants to take this deal, and the other person wanting to take that deal. But we will be taking you guys through the entirety of the story. However, Paramount maneuver of going directly to shareholders with all cash, high value offer is a really clear attempt to force Warner Brothers to reconsider what it calls an rather inferior Netflix proposal. The financing is secured from deep-pocketed backers and adding credibility to the very, very aggressive move. And why this really matters is that if the two companies combine, which is Paramount Plus as well as Warner Bros. Discovery, we are looking at a media library that includes DC, Harry Potter, CNN, CBS, Paramount Pictures, Nickelodeon, Max, and Paramount Plus. And this kind of consolidation would reshape global streaming landscape. And however, the bigger picture of it all is that it is definitely part of a bigger, broader trend that where media companies are realizing that the future is not just about creating or producing content, it's about owning scale, it's about owning distribution and being in control of what that looks like. The larger your library, the larger your and the stronger your subscription model, and the more negotiating power you have from an international front. And consumers could see fewer, streaming platforms, but more bundled content, which would be the significant impact of a deal like this happening. However, for creators, it could mean new commissioning opportunities for their content. However, it also could see tighter budgets being in play. And internationally, however, especially with emerging markets, this could be an open door for more localized content partnerships, as well as these companies push for global growth as a way forward into reshaping and restructuring the industry. Again, looking forward to seeing how this unfolds. Most definitely, I'm rooting for none of them at the moment. I still need to kind of, at this point, I'm not really haven't I can't decide which one I would kind of prefer as a better offer, but according to the value price point, according to the deal, according to the proposal that Netflix has done, it is quite significantly inferior to the one that Paramount has made. So we will see how this unfolds. However, Paramount is at, rather, Warner Bros. Discovery is at risk of paying that $2.8 billion if it does break up this deal and negotiation with Netflix. So we'll keep you guys posted on that story. Now, on to our next story for the day. Microsoft solidifies its position as the AI infrastructure leader. We spoke about NVIDIA yesterday in the episode. However, we are starting to see that in the AI race, most of the attention has been going on the front end, right? The models, the chatbots, the apps, the LLMs, etc. However, the real transformation, as we had unpacked yesterday, is happening beneath and underneath at the infrastructure level. And Microsoft is far ahead of its competition. It has been expanding its Azure AI data centers across multiple regions, including in Asia, the Middle East. They've also begun rolling out their custom AI chips, reducing reliance on NVIDIA and giving them tighter control over performance and cost. Now, why this really matters is whoever controls the infrastructure of the infrastructure controls the ecosystem. And AI models need massive computing power. And Microsoft is positioning Azure AI as the default platform for AI development globally. Similarly to what you'd see Amazon, building an AWS for its cloud development and cloud systems. That's exactly what Microsoft is looking to do with this, the Azure AI development globally. Now, the advantage of that would be with OpenAI running a significant portion of its workloads on Azure, Microsoft effectively becomes the backbone of many of the world's most advanced AI systems. The investment figures around the particular idea of Microsoft has made and has put into this type of infrastructure. It has, definitely committed staggering amounts to build and expand this infrastructure. The total capital expenditure, which is the CapEx, for its fiscal first quarter of in 2025, in October, Microsoft reported a record CapEx of nearly $35 billion US, a significant amount surpassing analyst expectations. The company expects this spending to increase further and predicted that it would remain constrained on supply from NVIDIA's GPUs at least until mid of 2026. The fiscal year of 2025, its outlook has some reports indicating that Microsoft might invest as much as $80 billion US in AI-enabled data centers in the fiscal year of 2025 alone. And this definitely has, global specific investments that have come into play, where India is one of the plays in this. Microsoft recently unveiled plans to invest $17.5 billion US in India over the next few years, and by 2029 to build out an AI infrastructure in India, its largest single investment in Asia. It also has been looking at Canada, where an announcement was made for an investment in Canada of more than 7.5 billion US dollars over the next 2 years. Another international investment being made to see this through is in Portugal, with an announcement being made by Microsoft of a potential investment of 10 billion US dollars in AI infrastructure within Portugal. And then the last sector, or rather the last region, being the United Arab Emirates, announcement being made of a $15 billion investment made into ensuring that there is an AI infrastructure being built and made within that region as well. Now, if considering the key details of what this looks like is that partnership with OpenAI is that Microsoft has a deep strategic and financial relationship with OpenAI. It has invested over 14 billion US dollars in AI in 2025, including this multi-billion dollar partnership with OpenAI. Microsoft holds a significant stake in OpenAI, which really helps drive the development and the deployment of cutting-edge AI model on Azure. The purpose-built hardware, the company is developing custom-built silicon such as the Azure Maya rather AI accelerated chip, and has built one of the most powerful supercomputers called the Azure Eagle to optimize for various AI workloads. And the focus on enterprise in this sense is that Microsoft emphasizes on security and compliance standards, making its infrastructure reliable and appealing to large enterprise customers, allowing them to move from AI experimentation to full-scale AI implementation. And looking at the broader picture of it all is that the shift from being a software company for Microsoft to becoming a foundational of the AI global ecosystem and economy, as I said earlier on, similarly to what AWS has done, or rather Amazon has done, by building AWS to become the foundation of the cloud computing economy. And we will be continuing to stay on the lookout for this particular story as well, because we had, yesterday about how much more investment is being done into platforms and into companies like NVIDIA, because I understand that the infrastructure of AI is as much important as is the front end part of it, which is the apps and everything being built on top of it. So it is interesting to see how this is going to play out, and who will win the AI infrastructure race. Right now it is NVIDIA at the top, but it does look like Microsoft is looking to play a very big part in it as well. But we'll continue to unfold the story as it happens. Now, our next story does look like Uber is expanding its autonomous delivery operations. Uber is expanding its delivery tests to new cities, and this marks an important step in the company's long-term strategy. Autonomous vehicles, rather, are now being tested in Los Angeles and in Dallas as part of Uber's plan to reduce delivery costs and increase efficiency. This matters because delivery is one of Uber's fastest growing business units, but it's also one of the most expensive to operate. Autonomous delivery removes driver's labor, or rather driver labor, which is one of the biggest cost factors for Uber in this particular type of business unit. Operational implications do mean that robots and autonomous vehicles, restaurants, and stores can operate later, deliver faster, and rely less on human drivers. And for Uber, it moves them closer to a model that scales globally without proportional increase in costs. This initiative represents a core part of the long-term strategy to drive efficiency and eventually reduce, again, as I said, human dependence for these types of deliveries. Now, Uber views itself not just as a ride-share app any longer, but as a comprehensive logistics network optimized by AI. Its focus now looking into AI and logistics means that autonomous delivery fits perfectly into this narrative of seamless tech-first delivery operation. Now, a hybrid model of this sense looks like the expansion will rely on a hybrid approach, combining human couriers for complex deliveries with autonomous robots and vehicles for simpler, shorter distance routes. The aim is to create a more resilient and more cost effective delivery network. And the expansion of this does look like it will be driven by key partnerships and technological integrations, like the Neuro partnership, which looks at Uber integrated within the Neuro's autonomous self-driving vehicles within its Uber Eats platform. The Neuro's fully autonomous zero occupant electric vehicles, called the R2, are designed for local errands and for food delivery. The Serve Robotics partnership also looks like Uber Freight has an expanded partnership with Severe Robotics, which makes sidewalk robots. Also, operational rollout, it looks like initial rollouts began testing in markets like Texas and Mountain View, California, with plans to expand into more US cities following the successful trials. And looking at technology integrations, the core of the operation involves deep integration into Uber's existing Uber Eats app. And customers can track their robots, their robots and the robotic deliveries in real time, just as it would with a human driver or courier. Receiving updates when the autonomous vehicle arrives. And why this really matters is because of the implications that this could potentially have. Of course, autonomous vehicles operate 24/7 without needing breaks, without potentially needing to speed up delivery times and expanding, service availability outside of the typical business hours. This also has an implication in cost reduction for Uber, because in the long term, automation significantly reduces labor costs, wages, benefits, insurance for drivers, etc., improving Uber's profit margins on deliveries, which is not what currently, right now has been on the lesser side of their business units. Addressing the labor shortage as well, automation helps fill the gaps in markets where recruiting human careers might be difficult or costly, and in areas and regions where this is a challenge as well. This does also look like the future of logistics. It signals a major shift in last mile delivery space, pushing competitors like DoorDash and Amazon to also accelerate their automation efforts. So already started seeing that Amazon has had its finger and its dip within this particular play as well. But Uber is really forcing their hand into ensuring that this is something that is integrated within their ecosystems as well. However, ultimately, Uber is building an infrastructure where your order might arrive via a self-driving car in the street or a small robot on the sidewalk, optimizing the delivery process by using AI to decide the most effective and efficient method. In the long term, this signals the next phase of the gig economy, one where technology, automation, and logistics infrastructure start playing a larger role than human labor. We've had several conversations and heard several reports about how automation, not just from a software point of view and an AI point of view, but the idea of autonomous vehicles, robotics, and that particular type of technology move happening simultaneously with AI really does see us having a different world in the next frontier. Because if we do have AI kind of infiltrating how we utilize these apps and these services, and then having autonomous vehicles driving our cars, having, sidewalk robots delivering to our doorsteps, I mean, this means that we don't necessarily meet, humanity and humans in and of themselves have not much part to play. And I recently had a stat that the drivers are, I think, one of the biggest careers, or has the most employed amount of people. There's a big pool of people who are drivers in the world. So the autonomous vehicle market is really disrupting that. And we'll definitely see what this looks like. I mean, again, game changing. Like, this is one of those things that will be told in history, like, oh, we used to have people used to drive cars, and you'll be telling your children that we used to have people driving cars in the future, and at that point cars will be driving themselves. But again, that's something to be on the lookout for, and we'll continue following the story and sharing it with you. Now, finally, the final story for the day is that the OpenAI has hired Denise Dresser, the current CEO of Slack, owned by Salesforce, to serve as its first Chief Revenue Officer, a CRO. The news was announced on December 9th, and the complexity and the context of this hire is that it is focusing on enterprise. OpenAI is looking to dig its teeth in the enterprise model of its company. Now, the focus on hiring is that the hiring of a seasoned the hiring of a seasoned enterprise software executive like Dresser signals OpenAI's strong intent to accelerate its growth within the corporate sector. While OpenAI's consumer-facing products like ChatGPT are widely known, the company is now intensely focused on getting millions of workers and businesses across every industry to use AI tools at scale. And the revenue generation structure is that as CRO, Dresser will oversee OpenAI's entire global revenue strategy, including enterprise sales, partnerships, and consumer success. Her primary role will be to convert the current high interest in OpenAI into submitted, reputable, and multi-year contracts to upend and increase its revenue structure. Experience in scaling with the experience in scaling platforms, Dresser has spent over a decade at Salesforce in senior sales roles and becoming Slack's CEO in 2023. And during her tenure at Slack, she oversaw the introduction of several AI features, giving her direct experience in scaling technology platforms and integrating AI into existing workflows. Now, moving past its pilots, according to Fidji, Simo, who is OpenAI's CEO of applications, Dresser's experience in leading that kind of shift before will help the company move businesses past the single-use AI tools and pilots and into full organizational adoption. And the move comes as OpenAI faces the challenge of turning a profit despite massive revenue forecasts, including an estimated $74 billion in operational losses just next year. And Dresser's role is critical in ensuring that the company can generate enough income to cover the enormous costs of running its AI models and as well as its data set. Rob Seaman, the Slack's chief product officer, will become the interim CEO of Slack following Dresser's departure. These stories today are all connected by necessarily one theme, which is consolidation as well as control. Whether it's entertainment companies merging or corporations building AI infrastructure, the world is most certainly moving towards ecosystem and far away from individual products and companies. It is quite interesting to see that, these companies are doing as much as we can possibly imagine into ensuring a more synchronized and a more collaborative approach into building the future. And today's stories remind us that that is something that will be how the next frontier is built. Thank you so much for watching the Vuyo Show. I hope that you learned a thing or two from this episode. And if you want to stay ahead of global news and global shifts happening in the industry of business and beyond, then make sure you subscribe, follow, and share this episode. I am Vuyo, your host, and I'll see you on the next episode.